New standards to promote electric vehicles have hit a speed bump. Real estate agency McGrath is putting up the sold sign, and tech bosses are selling their stock at levels not seen for years. Welcome to Fear and Greed, daily business news for people who make their own decisions. It is Tuesday, the 26th of March, 2024. I'm Michael Thompson, and good morning, Adam Lang.
Good morning, Michael.
Sean Aylmer still sunning himself on a Bali beach right now. Do you reckon he's listening?
Yes, of course he is. What better to go with a beachside cocktail than us?
Oh, well said. We should get that on the website. Immediately after the show, Adam, you are doing an interview today with Edelman's Tom Robinson, and this is all about trust.
Yeah, and look, the intersection of data and metrics like this about trust to me are just so fascinating. And I have to confess, Michael, I learned a lot about how well we are all leading through business, through government, and we have a few lessons to take home.
Yeah, Edelman have been doing this for years. The trust barometer, it comes out every year and looks at kind of how well businesses are trusted and government and other organisations. And some of those messages from this interview today were really quite startling in the fact that in a way businesses companies are being a bit more trusted by the public, but it's the business leaders that are letting the team down right now.
Can you imagine that, Michael?
I cannot. So it is well worth a listen. It is a very interesting conversation. It's coming up after the show. The main story, though, this morning, Adam, Australia is set to follow the US on lowering its proposed high fuel efficiency standards for petrol vehicles. It is the talk of Canberra this week, as well as the automotive industry and businesses more broadly, because Climate Change Minister Chris Bowen and Transport Minister Catherine King have been aiming to bring in new standards that, quote, catch up with the US in 2028. They want to boost the electric vehicle market.
That's right, Michael. The plan was to cut fuel emissions by forcing auto companies to provide more efficient vehicles and help increase the uptake of EVs. And this is meant to be a big contributor to helping the government with hitting its carbon emission reduction targets. The government was attempting to align with the US for the plan, but Joe Biden has thrown a spanner in the works. He walked back his plans last week for US standards, saying the impact on consumers and workers would be too great. He's giving car makers much more time to comply with the new rules. Biden was facing a lot of pressure from the automotive makers. Some car makers, particularly from Japan and Thailand, have also said high Australian standards would stop them from sending cars over here. Now, we are a pretty small market in the global scheme of things.
Yeah, there has been a lot of pushback locally on this, and it's become a bit of a mess for the government. So what is going to happen next?
Well, Bowen has said he's open to hearing sensible feedback on the proposed standards. They want to give Australians more choice of vehicles that cost less to drive, and that sounds good. They're in the consultation phase. It looks like they're pretty much set to lower the original plans for the standards. It's critical to note, though, that right now Australia is one of only two countries that does not have fuel efficiency standards. The other that does not is Russia. So some standards seem to be a certainty, and it's all about finding the sweet spot on what they should be.
All right, we shall certainly be hearing plenty more about this, I suspect. Taking a look at local markets. Now, a pretty strong day yesterday for the S&P ASX 200. It closed up 0.5% to 7,812 points. Adam, it's closing in on that record high set not so long ago on March 8.
There were rises across almost all the sectors on Monday, helping drive the gains, led by real estate investment trusts and energy. Healthcare and IT also had a solid day. The one category that limped along was consumer discretionary, which remained pretty flat. West African Resources, Goodman Group and Elders all did well over the day. ALS and Life360 led the declines.
And what about international markets?
So iron ore prices might finally be nearing a floor, and that's according to a new ANZ analysis. Following a slip in the commodity price over the weekend, the bank's analysts think expectations around demand are going through a reset as weak consumption from the property sector, and that's particularly in China, gets offset by rising demand from other industries. ANZ reckons we'll see iron ore trading at around US $90 to $110 for the rest of 2024.
Another big trend internationally, Adam, in 2024 is going to be corporates snapping up stocks. It seems Goldman Sachs forecasts corporations will be net purchasers this year of $625 billion worth of US equities. Now, that is a lot of buybacks and cash M&A. Last year, corporations were net buyers of $635 billion in equities. If this year goes as Goldman expects, it'll be one of the strongest annual results in years.
And one more, Michael, lithium prices are also attracting some attention because Citi has now joined Goldman Sachs in taking a bearish outlook. It thinks the market is going to experience a surplus over the next year and a half and prices will need to correct soon. Prices are currently surging, but Goldman previously said this was due to traders covering short positions. And just quickly, gold has climbed again to US $2,171 an ounce, and the Aussie dollar is sitting around 65.3 US cents.
All right, so not much changing on the Aussie dollar front.
Nope, steady as she goes.
Fairly consistent. We'll be back in a moment with the rest of the day's business news. Adam, real estate agency McGrath's board has endorsed a takeover bid from Knight Frank and Bailey's, and the business will now be delisted.
Yeah, Michael, this comes after a rocky few years on the ASX for McGrath, which has been helped more recently by the surging property market. The consortium offer is worth 60 cents a share and has now been backed by the McGrath board, which collectively controls 48.1%. When the offer was made, shares were trading at around 47 cents. High-profile founder John McGrath, who is the CEO of the company, said he would be receiving equity for his 23.3% stake as an alternative to being paid out. His role as CEO is not going to be changed, and he said in a statement that he looked forward to continuing to work with the business, but also leaning in to the opportunities available from having international partners. Now, Sean will surely enjoy listening to the words leaning in there as he lays by the pool in Bali. McGrath shares jumped 24.5% yesterday.
I don't think Sean will enjoy hearing that anywhere near as much as I enjoyed watching you say that, because you were physically...
It was his quote. I had to say it.
I know, but you actually almost physically recoiled as you said it. Just this little kind of shudder went through you, and it was actually... Now I realise that there are trigger words for you, and leaning in is probably about as bad as touch base.
Oh, God. Yes, there's a tension across the shoulders, an elevation in the heart rate, and just a general difficulty in saying those words out loud.
And your pupils have dilated.
It's like a heart check.
Yeah, goodness me. Anyway, we need to move on before you need to sit down. The regulator's crackdown on company directors without a director ID has begun, Adam.
Yes, Michael, do you have your director ID?
I do. Do you have yours?
I do. I was one of the first, I reckon.
I guarantee you were pretty much waiting on the phone. You know who you remind me of, Adam, and I'm sorry to do this.
Oh, dear.
You're very familiar with The Simpsons, aren't you?
You're going to say Ned Flanders, aren't you?
It is Ned Flanders. You know that scene when the moment kind of, because obviously they work on a different kind of financial year to Australia, but the moment the fireworks were going off, he gets up to start working on his tax so that he can be the first one. The first one from the new year to get his tax in. And you are Australia's Ned Flanders in a really good way.
Let's move on.
I'm sorry. Please, on with the public service announcement.
So, directors all now have an obligation to have a director identification number, and that's known as a director ID. ASIC has now commenced prosecution for the first time against a director who failed to get a director ID, which requires first verifying their identity with the Australian Business Registry Services. Those that fail to do so may face penalties up to $13,320. So it's well worth doing.
Yeah, hefty fines. This is an interesting one, Adam. The superannuation lobby is stepping up its campaign against the Coalition's superannuation for housing policy, which could allow first-time buyers to actually dip into their super in order to kind of scrape together a deposit for a home.
Yeah, Michael, the Association of Superannuation Funds of Australia has published new research showing couples aged 25 to 34 would struggle to have more than $150,000 from super for a home deposit of 20%. The research looked at the super balances of 300,000 taxpayers combined with Australian Bureau of Statistics data and found those in the top earners in this bracket in Sydney would be unlikely to have these funds available. In Melbourne, the richest 20% of young people aged 30 to 34 would have $120,000, about enough for a median apartment deposit. The super industry is concerned about the policies the coalition will take to the next election after it previously took a proposal to allow first home buyers to access $50,000 in super for a deposit and is now looking at increasing that sum. Another tidbit of food for thought for the super sector is that Tim Wilson has just won the Liberal pre-selection for the seat of Goldstein, putting him up against Teal Zoe Daniel. Now, Wilson was a serious opponent of the super sector in his last stint as an MP and a big supporter of letting individuals use super to fund a home.
Adam, there is a second jobs boom in Australia. I think we can comfortably call it that now. It is becoming increasingly common to take on a second gig, and a new survey shows about a third of Aussies feel financially pressured to take on an extra role. There's been an historically high proportion of people holding multiple jobs since COVID hit, and the Bureau of Statistics puts the number at just 30,000 people shy of 1 million who had more than one job as of December. That is a lot of people.
Yeah, and that's nearly 8% of workers. And this new survey, which is from Finder, found about 40% of employed women and nearly a quarter of men are under the pump to get a second gig. It's Generation Z, those born 1997 to 2012, who are feeling the pressure the most, with more than half looking for those extra hours in a second job to make ends meet. For millennials, that's those born between 1981 and 1996, it was about 40%. The Australian Bureau of Statistics data shows most multiple job holders right now are women, likely to be young and tend to work their main job in the community and personal services industry. Healthcare workers also tended to have multiple jobs.
This is a really interesting one, Adam. High net worth women in Australia do not want to be stereotyped into conservative investments and are predominantly invested in real estate, shares and cash, according to a new white paper from JB Weir, yet there are some interesting differences with their male counterparts.
Yeah, the research found high net worth women have an equal risk appetite to men, with 1 in 5 identifying as an aggressive investor. They're also just as confident about their knowledge and skills with investing, but their priorities are different to men, with half of the women surveyed saying their top priority when engaging with a financial advisor is to access a range of different investment options. Only about a third of men said the same. Women were more likely to value and consider an advisor's track record, but also their transparency and communication skills. The white paper also found a shortage of female financial advisors, and it found that older women are less likely to have a trusted advisor.
All right, turning to international news now, Adam, and the big trend in international markets right now is the heavyweight tech bosses selling hundreds of millions of dollars in their company's shares over the first quarter of the year. Now, this includes big names like Peter Thiel, Jeff Bezos, and Mark Zuckerberg.
Michael, Verity LLC tracks insider trading disclosures, and insider selling as a ratio to buying is at its highest level since early 2021. Peter Thiel sold US $175 million from Palantir this month. Bezos sold US $8.5 billion worth of shares in Amazon in February, and Amazon CEO Andy Jassy sold US $21.1 million of stocks this year so far, and Zuckerberg sold US $135 million worth of shares in Meta in February. The Financial Times points out that sales were pent up last year as shareholders avoided selling due to valuations, so that might explain some of it, and these are big shareholders who still have large holdings. But analysts have been surprised at the volumes, and there's speculation the big boom in tech stocks is coming to a close. It's one for investors to watch closely.
Stellantis NV, which makes vehicles like Jeep and Ram, is slashing 400 people from its workforce amid a move towards EVs.
The Wall Street Journal has reported that the jobs being cut will primarily be white collar, and that represents 2% of its workforce. The cuts will kick in from March 31, so that's just days away. The Journal cited a statement from the company that warned about the challenges facing the auto industry. Stellantis said there are, quote, unprecedented uncertainties and heightened competitive pressures, unquote, globally. And this has led them to looking into improve efficiency and optimise their cost structure. In February, Stellantis said it faced a turbulent year amid the launch of new EV models.
Okay, last one, Adam. This is a big story, this one. China has blocked Intel and AMD chips from being used in government computers, according to a report from the Financial Times. This marks another step up, and I'd say a fairly significant step up in its tech war with the US.
China's new procurement guidelines will mean agencies in China have to phase out US microprocessors from computers and servers. The guidelines also shift agencies away from the Windows operating system and towards locally made options. The Financial Times says this is part of shifting towards safe and reliable processors and purchasing new products. A list matching this description was circulated last year with all China-made options, and this is a ramping up in the fight for global tech dominance, with the US trying to bolster local semiconductor output and be more self-reliant by launching the 2022 Chips and Science Act that helps support local production.
All right, up next is the Fear and Greed daily interview. Your guest today is Tom Robinson, who is the CEO of Edelman Australia.
That's right, Michael. And as we mentioned at the top of the show, this is about trust in brands. So whether you're working at a company or in a government institution, charity, whatever it is, the value of trust as an economic driver is something this report really focuses on.
Yeah, it is up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Adam.
Thank you, Michael.
It is Tuesday, the 26th of March, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X, TikTok and Facebook. I'm Michael Thompson and that was Fear and Greed. Have a great day.